So I will be taking Q&A periodically in the chat. Feel free to leave a question there, and I will try to get to everything. If I think that I'm going to answer the question later on in the appointment, or later on, in the event, I'll ignore it. But beyond that, I will attempt to answer any questions that you may have. Okay, so I'm just going to share my screen here so you can see my beautiful slides. Which, by the way, I didn't realize that the wording on this slide would sort of disappear with as soon as I put the image up there. So yeah, I didn't test this out very well. But anyway, let's talk tonight about taxes for self-employed artists. Since there are so few salaried artists, like salaried as artists, of course, self-employed artists is almost a bit redundant. So to get started, the opening for the YouTube video. Oh, I know. Okay, so to get started, a little bit about why I'm the one talking to you tonight. I have been a professional tax preparer, tax advisor, well, I wasn't an expert to start with, but I've been working in taxes since 2002. And pretty much from the beginning of my career, I was focusing on freelancers, and I was focusing on people in the arts. My first job in taxes was for an office that worked for people in the arts. When I went out on my own, I was working for a lot of people in the arts as well, because that was what I knew the best. And it's still what I like to work on the best, because both these things appeal to me. Creative people appeal to me, but also self-employment appeals to me, which also requires self-employment, and business running itself requires a lot of creative thinking. It's a lot of problem solving. So in fact, artists are ideally positioned to be self-employed, which is a good thing, because like I said, they usually are. That's where I've been. That's what I've been doing for the last 20 years. And then as for doing these webinars, and previously I used to do in-person seminars. I don't really do that anymore. There's a reason why I keep doing these. So I did a seminar on Tuesday. I did one last Thursday. I did one the Tuesday before that. I do a lot of these, and they are a lot of work, and yet I keep doing them. Why? So the reason that I keep doing these tax webinars, and the reason that I'm so passionate about informing people about the tax issues that involve self-employment, it's really encapsulated in a story that I do tend to tell at the beginning of all these events now, because it is so illustrative of why I'm here. So one fall, so it wasn't in tax season, it was in the fall, we got contacted by a person that did not work with us yet. She was a self-employed creative. She was actually an actor, but it's the same kind of world. She did her art, she billed for it. That's how she made her living. She had been working more or less constantly, or at least enough, for 10 years. She made a very modest income, very modest. It was enough to support herself, barely, but she got by, and that's what she did. And then here's what happened. As it turned out, she had not gone into acting because she loved doing her taxes. She had gone into acting perhaps because she likes doing everything that's not like doing your taxes. At some point, the Canada Revenue Agency contacted her and asked to see a tax return, because she hadn't filed in a while. And she did what a lot of people do in this position, which is ignore it. She ignored it. The letter is scary, and they want something, and it's from the Canada Revenue Agency, and nobody likes that. So she kind of ignored it. And so what CRA does, if they send you a letter and they want something and you ignore it, they send you another letter. So they sent her another letter, and they said that they would really like to see that tax return, and also the one that came after it, because by this time, more time had passed. And she ignored that letter. And then they move on, and they moved on to sending another letter. So they sent a third letter. You can imagine what happened. Nothing. Now, from this point, after the Canada Revenue Agency has sent multiple letters and they've gotten no response, not just that they haven't got what they asked for, which was the return, but not even a call, like nothing. They'd gotten no response. They weren't sure that they were getting her attention. So one thing that the Canada Revenue Agency will do if they have not received a tax return from you, and they've asked for it, is they will do what's called a notional or an arbitrary assessment. And what that means is that they basically make up a return for you. They guess based on your history, what you filed before, or what information that they do have, and they'll file a return that is usually not a good return. Like they won't claim as many expenses as maybe you're entitled to because they don't know what you're entitled to. They'll sort of overclaim your income and underclaim your credits. And they basically create a return that is possibly the worst possible tax outcome you could possibly have, given your situation. And they'll present you with a tax bill. Now, the downside of this, like I said, is that this return that they file for you is a terrible return. The upside actually is if you file the same return, they will delete their return and replace it with yours. So there is something you can do here. But anyway, they filed that return, hoping perhaps that she would file her own return or pay the tax bill that was generated by this return. You know her a little bit now, so you can guess what she did, which is nothing. She did nothing. She didn't pay, she didn't respond, and she certainly didn't file a tax return. So the Canada Revenue Agency steps it up a little bit to get some kind of response from a person. And what they do at this point is garnish your wages. Now, this person was not primarily a salaried person, but she does have payers who pay her, via T4s or T4A slips. So those slips go to the government. So the government knows who her payers tend to be. And, garnishment, we all know that it involves your income being diverted to the Canada Revenue Agency. We know that that's a primary issue with garnishment, but what people don't really realize is that for that to happen, the Canada Revenue Agency contacts everybody who pays you and tells them that they have a court order that now obliges them to divert some income. So garnishment is not just sort of an issue of finances. It's also sort of an issue of face. It's an issue of pride, because now the people who tend to pay you know that you have problems with the tax man, the tax person. So it's kind of, arguably, it's a little bit, not humiliating isn't the word I'm quite looking for, but it's embarrassing. Somebody that normally doesn't know the inner workings of you and the Canada Revenue Agency, now they know something, and it's just horrible. It's just horrible. Now, does anybody? I invite people to put your guess in the chat here. Does anybody want to guess what percentage of her income? Because the government can sort of say what percentage of your income they want to be diverted to them. They tell your payers what percentage to divert. Does anybody want to guess at what percentage of her income was being diverted to the Canada Revenue Agency to pay a tax bill that they had invented out of thin air? Does anybody want to guess? 50%. Okay. Anybody else got a guess? Whoever gets closest gets bragging rights, which is worth so much in this economy. What with inflation and all, 40%. All right. Any more votes? 15%. Okay. All right. We're going down. Nobody wants to get near Alex there with that 50% guess. Okay. I'll give you 5 more seconds. Anybody else want to get a vote in? Remember, the person who gets closest gets bragging rights. So valuable. What is going on? All right. And we will close the voting in 4, 3, 2. Alex, you watch too much Price is Right. Okay. Closing it off. Okay. Well, I will leave you guys to do the math as to who won. The answer is 100%. That, yes, Alex, you win. She lost, but Alex wins. Yeah, 100%. So if she earned anything from any of the payers who were contacted by the Canada Revenue Agency, those payers were bound by law to divert all of it to the Canada Revenue Agency. Now, you may think they were trying to kill her. Really, they were trying to get her attention. And it did. It did. That's why she contacted us. So she needs to file these returns to bring those taxes down, because the amounts that they had filed for her were nonsense. She knew she didn't owe that much, but to prove that she didn't owe that much, she had to file something. So she came to us. Now, she had not made a ton of money as an actor, and I was trying to give her as many discounts as we had available to us to give. But the bottom line is that if you do 10 self-employment returns at once, it's a big job. It is a big job, and we have to charge for that job. And so even though I brought it down as low as I could, it wasn't that low. My fee quote was still quite a bit of money. It's 10 years worth of returns, and she never made that much money to begin with. So to my complete lack of surprise, she never responded to the quote. You may be seeing a theme here. There's a leitmotif running through all this. Leitmotif. Anyway, so she didn't respond, and we went on with our lives until she did respond. A few weeks later, we actually did get an email back from her, and she said, "I'm sorry I didn't respond sooner, but I have been evicted." So let's recap, shall we? She's got a huge tax bill. Every legal dollar that she can earn is being diverted to the Canada Revenue Agency, and she's been evicted from her apartment. Now, I don't want to bury you in tax jargon here, but we have a word for this, and that is, this is a disaster. It's a disaster. This is awful. It's a terrible, terrible situation. And what's awful about it, too, was that none of it was necessary. What we're going to talk about tonight in the next hour and a half, hour and 3/4, is all your responsibilities, everything you need to know to not get into this situation. Because to take care of your taxes when you're self-employed, it is a job, and it's a job that you didn't really want. If you had wanted to do this work, you would be working for me instead of being an artist. People don't tend to go into the arts because they love spreadsheets. I get it. But it's unavoidable, as we all know. Proverbially, taxes are unavoidable. However, the burden of taking care of your taxes is not unmanageable, and it's not completely as onerous as you may think. And we're going to cover everything you need to know to never have this problem before we wrap up tonight. I'm going to cover pretty much everything you need to know. If she had attended something like this 10 years before, she would never have been in this situation. That said, it is my experience that there are more people in this situation than you might think. If you are one of them, I do have a guide, the step-by-step guide as to where you go from here, because there is a way forward. There's work to be done, but there is a way forward. So if you're interested in that way forward, you can use the QR code on the screen right now to get my guide to how to get out of that. And I will also say that this guide and the other guides that I'm talking about will be available to you later on in this presentation. I don't want you guys to get too tied up in knots taking notes about what we talk about here, because every important thing that you need to know is in a series of resources that I have created for you that you will be able to download through links that I will give you in this presentation. So relax, just listen. All the important points will be available to you later. You're just going to sort of sit back and enjoy this very dull documentary about taxes tonight. You don't actually have to do anything, and you'll be able to get those resources for free when we're done. So, welcome to the wonderful world of self-employment. The reason I use this image is it's sort of a drive into the unknown, but also I tend to think about being self-employed versus being an employee, like being the driver versus being the passenger. You know, the driver gets a lot more control over what they do. They get to decide what music is on the radio. They get to decide which way to turn. They get to decide which roadside attraction is worth stopping for. They get to make all those decisions. But at the same time, and because of that, they do not get to take a nap while driving, unlike passengers. They have to be alert to more things than passengers or employees. What things? These things. The 5 things that are special and unique to self-employment that salaried people don't really worry about. And the first one is, well, this isn't really a worry. It's that self-employed people tend to keep a little more money in their pockets than employees. It may not seem that way, but it's true. And this is really by virtue of the fact that you get to write off certain expenses that as an employee, you might have the same expenses, but not be able to write them off. But as a self-employed person, you can write them off. When you write them off, that brings down your income. Bringing down your income brings down your tax bill. So you actually do get to keep a little more money in your pocket as a self-employed person sometimes. You also have to be aware of the rules around the GST and HST. You also have to know that you have other obligations, for example, setting aside money for taxes, which employees tend to not really do, but they don't really have to. But a self-employed person does have to always be aware that some of the money that's coming in is actually going to have to go back out as tax. We'll talk about how to estimate how much that's going to be. You have more things to file and you have more deadlines to be aware of. We're going to talk about that as well. And because you have many more choices about what you file in your tax return, you are going to have to protect yourself and defend those choices, potentially defend those choices by keeping good records. And we'll talk about that as well. So starting with the first thing, which is the fact that you get to deduct business expenses. So in the tax system, you do not get taxed based on what you bill. You get taxed based on what you net. So after you collect your revenue, you subtract all the expenses associated with earning that income, and what's left is your net. You get taxed on that. And therefore, the more you can write off, the less your net is, the less your net is, the less your tax bill is. So the heavier your deductible expenses are, the lighter your tax bill is. And one really nice angle here is that there are some expenses that almost everybody really has, but only self-employed people get to use them to reduce their taxes. For example, your vehicle, your home, and your computer. Everybody's got a home and a computer, and a lot of people have vehicles, but only people who are self-employed have the chance to write those things off, at least in part. So this is where it's all good for the self-employed person. But that's not all a self-employed person can write off. There are actually an infinite number of potential write-offs based on the fact that there are an infinite number of things that you could potentially spend money on. But obviously, you can't deduct absolutely everything. Only some of the things that you spend money on are valid. And people are often asking me, well, can I write off this? Can I write off that? Is this allowed? Is that allowed? The thing about deductible expenses is it's actually context sensitive. What you do and how you do it has a big impact on what you can deduct. So what one person can deduct is not what somebody else can deduct. There are some rules about certain kinds of expenses. For example, maybe you don't know this, but nobody's allowed to write off a gym membership. Nobody. Technically. There's a rule about that. But most things don't have a specific rule, yes or no. There's no big book where you can just sort of like look up the thing that you just bought and see if it's deductible. It depends on what you do, and it depends on how you do it. And the thing is that rather than a reference tome, which doesn't exist, you actually have to apply a principle to everything you're considering deducting against your business income for tax purposes. And what I recommend is that you use the same criterion that the Canada Revenue Agency uses. And this has two effects. One, it's good business, actually. And two, if you're ever called upon by the Canada Revenue Agency to defend an expense, you are going to defend it using the same criteria that the Canada Revenue Agency uses themselves. So criterion, actually, there's just really one. The criterion is the reasonable expectation of profit. Now that is a deceptively short phrase, but every word is important. So let's take it word by word. First of all, profit. Profit is what's left after you deduct your expense from your revenue. So what that means is relative size. What you spend on your business to earn the money should be less than you earn because you spent it. So you want the expense of doing something to be less than what you're going to bill for that something. Okay, that means that you have a profit. Obviously, we all want that. We don't want to spend more money on our business than we actually earn. That's kind of nuts. Next is expectation. So we want to profit. We want the revenue that comes from investing in a business asset or a business expense. We want the revenue to exceed the cost and give us a profit, but expecting it to is enough. It doesn't actually have to profit you. You just have to expect it to. However, that expectation has to be reasonable. And when the Canada Revenue Agency uses the term reasonable, what they mean is from the perspective of a disinterested third party, so somebody who's got no win, no loss here, would they feel that your expectation of profit is reasonable? And in this case, Canada Revenue Agency kind of is that disinterested party. But anyway, you have to look at it from the perspective of someone who's not you, a disinterested but reasonable person. If all these are true, then you have a reasonable expectation of profit based on that expense. And this reasonable expectation of profit doesn't just apply to everything that you spend on your business. It also applies to your business as a whole. And what I'm referring to here is the fact that you can have losses, right? You can have years where you invest more in your business than you earn. That's okay. That's a natural part of business. It's something that just happens. There are times when the time scale is such that you spend a bunch of money in one year and you make it back and then some, hopefully, in another year. In terms of the arts, because it can take so long to establish your name and establish your connections, sometimes those losses will go on for years before the profit starts coming in. Also okay. But if the Canada Revenue Agency ever questions you because of your continuing losses, what you want is to be able to make a reasonable case that you expect a profit over the lifetime of your business. That doesn't mean that you're going to take $10,000 a year losses for 3 years, and in the fourth and final year, you're going to make a buck. It means that you're going to make back all your losses plus a little extra. That's the profit over the course of your business. And that's the case that you want to make to the Canada Revenue Agency if they ever question you on your business as a whole. Now, I mention this particularly to people who are involved in the visual arts, because visual arts are an area where it's a very long and hard process sometimes to actually get to profitability. And the Canada Revenue Agency will let it slide for a while. But after a while, they may start to ask you, do you have the reasonable expectation of profit? And you'll know this because first they'll audit you about your expenses to have you defend all the expenses you're writing off, but then they'll send you a questionnaire. And that questionnaire is trying to get at the heart of whether or not you're trying to make a profit. Now, for the Canada Revenue Agency, the opposite of an artist for profit is a hobbyist. That's their term, a hobbyist. And the problem is that when artists hear hobbyist, they start to defend against what they see as a hobbyist, which is somebody who's not a true artist, somebody who's a hack or just a, I don't know, a hobbyist. And they'll make the case that they're not a hobbyist by showing their bona fides, the galleries they've been displayed in, the magazine articles that they've been featured in. But the Canada Revenue Agency doesn't see the scale as true artist versus hobbyist. They see the scale as true business versus hobbyist. In other words, an artist for profit can write off their business expenses, but an artist for art, if they're showing losses all the time, Canada Revenue Agency doesn't like that. Those losses have a real positive effect on your tax bill. Losses are good for reducing tax. And this is why they get the attention of the Canada Revenue Agency. But too many losses, not only are you saving a lot of tax, i.e. not paying a lot of tax, but the Canada Revenue Agency starts to say, well, if you're really in business, you want a profit, right? Don't you? I did have a person contact me. They had received this questionnaire and they weren't my client when they got the questionnaire. If they had, I would have told them not to say what they said, because the Canada Revenue Agency essentially probed them about their attitude toward profit. And their answer was, I don't really care about profit. What I care about is advancing the cultural conversation in Canada, which is a beautiful sentiment. And the Canada Revenue Agency responded by saying, you're not in business. We're reversing out all your losses. We need you to pay back all the tax those losses have saved you, and you can never write off expenses again. You're not in business. So that answer, while true and beautiful, is not what you want to tell them, because it's not the scale that they're asking you to defend. This is not, when they call you a hobbyist, they're not saying that your artistry falls below a certain level. They're saying that your attitude toward business may be falling below a certain level. And that's the thing that you have to defend against. You must defend that you have the reasonable expectation of profit over the course of your business. Now, does anybody have any questions about this section before we move on? While we're waiting for people to gather their thoughts, tax trivia. So think about this. What special tax imposed by Elizabeth I, Henry VIII, and Tsar Peter I, otherwise known as the Great, could only be levied against men and certain circus performers? Is there anybody? Usually nowadays I find that people tend to know this one. It's too bad. It's a shame. In the meantime, if you do want more information about business expenses and deductibility and how CRAs, there are some rules about certain types of deductions. Maybe you want to look those up. And I do talk about them in this guide, Business Deductions Made Easy. The guide is free. Just aim your phone toward the QR code or type in the URL and you can have it sent right to your inbox. Okay. Any guesses about this special tax? If I get no guesses, then the first person who guesses wins, whatever they guess. Elephant riding pants. If you are actually making a profit as an elephant rider, you could probably write off those pants. But anyway, but no, that's not the tax. So far, Alison Devereaux is winning here. Do you want to take this lying down? There's a clue in the picture, by the way. There's a clue. I made a clue. What is this tax? Hair products. He does have good hair. The answer is, of course, the beard tax. They would tax you for wearing a beard. There was reasoning. There was reasoning. You may not agree with the reasoning, but there was reasoning. Nope, beards, not tents, beards. You had it in, oh, come on. I know you didn't mean that hair. You don't fool me. I know you didn't mean that hair. Okay, I'll give you half a point for hair. Plus, you were yeah. I'll give you half a point for hair. So the beard tax, the English kings, Queen Elizabeth the First and Henry VIII, for them, the beard was sort of reserved for nobility. You know, they didn't want peasants to wear beards, and I guess they wanted to be able to sort of spot a noble at a distance. Although honestly, couldn't you just tell by their shoes or lack thereof? I don't know. But essentially, they would impose a tax. You had to be rich enough to pay it in order to wear your beard. And that's what kept the riffraff from wearing beards. Peter the First, otherwise known as the Great, his great passion was to get Russia taken seriously as part of Europe. You know, Russia was at that time seen sort of as a backwater, sort of behind everybody else. And, you know, it's split between Russia and Asia, and Europe was kind of saw itself as the peak of, you know, human civilization. And so did Russia. They saw they saw that too, and they wanted to be considered, or Tsar Peter wanted them to be seen as part of that civilized part of the world. And because of, I guess, because of Russian orthodoxy, he saw a lot of scraggly beards around, and he felt that the country would look a lot less like a bunch of peasants if they would shave. So his reason for wanting you to you know, not wear a beard was to modernize Russia and to make it look a little more European in his eyes. However, he couldn't stop you from growing a beard. So what he would do is they would impose this tax. When you paid the tax, you got that little coin there. That the coin is the beard token, which you could carry around with pride. And then if you were spotted wearing a beard, you could use the token to prove that you had in fact paid the taxes on the beard. So that was your beard token. Now you had the right to wear a beard. Okay. Moving on to a topic near and dear to everyone's heart, the GST. I'm here to explain the GST to you in a way that you will never forget, and you will love this tax as much as I do, which is to say modestly, or, you know. But let's start with some terminology. So the goods and services tax is a sales tax on goods or services in exchange of value. It's a sales tax charged at the federal level. Meanwhile, there are other sales taxes that are charged at the provincial level. We call that the PST, or the provincial sales tax. And the provincial sales tax, because it's set by the different provinces, have, you know, the provincial sales tax rules are different from province to province. And they, of course, differ from the federal rules. For example, about what exactly gets taxed, how often you have to file, you know, what you have to file, the forms, all that stuff is different between the provincial sales tax and the federal sales tax. And some provinces have opted to simplify things by combining the provincial sales tax with the federal sales tax into a harmonized sales tax, and that's the HST. And what they did was the provinces that they're called participating provinces. Ontario is one of them. The Atlantic provinces are also harmonized. What they did was, as part of that simplification, as part of that harmonization, they dropped their own rules and essentially adopted the federal rules. The federal rules in terms of who files, in terms of how often you file, how you tax it, you know, all those rules, they dropped their own idiosyncrasies and they just adopted the federal system. And so for that reason, when I go forward, sometimes I say HST, sometimes I say GST, sometimes I say both, but really The HST is a species of GST, and the rules are the same for both. So don't mind me if I sometimes say one or the other. I mean, they're all the same from the perspective of how it all works. So, is it your concern? Well, you may have heard of the $30,000 rule. The $30,000 rule says that if you bill more than $30,000 in a 12-month period, you must register and become part of the GST-HST system. You must become a registrant or a participant in the GST-HST system. It's not exactly 12 months. The literal definition is if you bill $30,000 within 4 consecutive calendar quarters. So it could start on July 1st and you cross that $30,000 threshold between July 1st and April 14th. Even if you didn't bill $30,000 in either calendar year, the fact that you billed $30,000 in a consecutive period of 4 consecutive calendar quarters means that you've crossed that threshold. You're no longer what they call a small supplier. A small supplier has the option to just not register. Once you're no longer a small supplier, you are obliged to register. I will also say that a small supplier is allowed to register. You don't have to cross 30,000, but a small supplier is not obliged to register. And I will also say that this $30,000 amount, it's gross, not net. So it doesn't matter what your expenses are. It's how much did you bill? And it does not include income from any source other than self-employment. So if you have a salaried job or if you have investments, you have some other source of income other than self-employment, that source of income is not part of this $30,000 calculation. Only the income that you earn through self-employment is part of that $30,000. So how does it work? This is the funny thing about the GST is that people tend to think that it's a really complicated thing. And the reality is that its basic rules are very simple. In fact, I would say that the GST is one of the simpler topics of the Canada Revenue Agency's whole world. If you want something complicated, check out capital cost allowance. The GST-HST system is so simple, I'm going to put it all in one slide. Okay. So the first thing to know about it is that it doesn't cost you anything. If you're registered, you do not end up poorer because you're registered than you would have been if you weren't registered. And the reason for that is because you only have to remit to the government under this system what you collected from your payers or your clients on top of what you bill them. So you're going to bill them this tax. They're going to pay you this tax on top of your fees. That's what goes to the government. And meanwhile, any GST or HST you spend on your business expenses, your deductible business expenses, you're actually going to get that back. Being registered for the GST-HST means that from now on, whenever you spend the GST or HST on an expense that's relating to your business, you're going to get it back. That's just unique to registrants. And all this is communicated. You're going to communicate with the CRA what you've billed and what you're getting back via a GST return. It's separate from your income tax return. It's got slightly different filing rules, but basically that's what the GST return does. It calculates how much you billed, how much you billed in tax, how much you spent in tax, and the difference, which is what you're going to have to send to the government. So looking at this sort of in a more visual way, let's say you're not registered for the GST. So you're going to bill a certain amount to your payer, and you're going to spend a certain amount in order to earn that income. So in the simple example of a painting, you're going to sell the painting, but you're going to spend some money on brushes to make that painting. That's gone. And what's left is your profit. This is what you're keeping. Okay. Now, the same painting the same situation, but now you're registered. So you're charging the same amount for the painting, except that on top, you're adding some GST or HST. Meanwhile, you still have to buy the paint. But assuming the paint was bought in Canada, there is actually a certain amount of GST or HST included in the cost of that paint because you paid it when you bought it. So you spent it, and now you're going to send the government the extra that you billed on top of your fees. Remember, this is on top. It's not part of your fees. And they're going to give you back the GST or HST you spent on your paint. So now the amount that you kept is actually a little bit more. So in this way, it is mathematically impossible for a GST registrant to not have more. Well, it's impossible for a GST-HST registrant to end up with less in their pocket than they would have if they were not registered. Registrants keep more money as a rule, always. So that's a reason to register. Even, if you don't really want to be registered and you kind of have to and you don't really want to, there's an advantage to that. However, there's also the filing of the returns, the worrying about the money, that keeping it aside or whatever. I mean, I totally get it if you don't want to register. And the fact is that if you cross that $30,000 threshold and you don't register, nothing is going to happen. Nobody knows you crossed that $30,000 mark except you. Like you issue the invoice. The payer doesn't know what you earned in the previous 4 calendar quarters. They pay it. You're at that point the only person who knows that you billed more than $30,000. So what's to stop you from just not registering? A warning about this. People often ask me about whether they can deduct this expense or do that. What can they do with their business and not get flagged for an audit? People talk to me a lot about red flags. Is this a red flag for an audit? Is that a red flag for an audit? The fact about audits is that the chances of getting audited it's never zero, but it's actually always pretty small. It's pretty small, though it's never zero, but it's small. But if you don't register for the HST when it's time to register, and you continue to bill over $30,000, year after year, but you're not registered, what's super common is that the Canada Revenue Agency will notice. A couple years down the line, they'll notice. And what they'll do is they will retroactively register you. Not only do they say, okay, you know what? You should have registered in 2020. We just back registered you. Hand over all the GST you should have collected in that time, right? Which you don't have because you didn't bill it. And that was 3 years ago. It's awful when this happens. And it does happen. It's way more common than an audit. It happens a lot. So I really strongly advise that if and when you cross that $30,000 threshold, as I hope you all have or will soon, do register for the GST-HST. Don't just duck that. It's important. If you've already crossed that line and you didn't register back when you should have, but you haven't been contacted by the CRA yet about it, I have good news. You're fine. Just register. Like, call them tomorrow. It'll take 5 minutes. Call them and register. Because as long as you register before they ask, they don't back register you. Like, even if they can see that you should have registered in 2020 and they were going to call you, but they hadn't gotten around to it yet, if you register before they get around to it, they don't nitpick about the fact that you should have registered sooner. So if there's anybody participating right now who has billed over $30,000 and they didn't register, and I've just put the fear of God into you, good. But all is not lost. Just go ahead and register. Register tomorrow. Now, for those of you who have not crossed $30,000 and don't want to register, I'm going to make a case that maybe you should consider it. The thing about being registered for the GST, one of the requirements of being registered is that you have to quote your GST number on all your invoices. And you have to show the GST that you're charging on every invoice. That means that any Canadian who is in business themselves, who gets your invoice, automatically knows whether or not you're registered for the GST. And that means if you're not registered, I see a question in the chat, by the way, about grants. I actually have a slide about that. We will talk about that in a second. So yeah, if they see that you haven't registered, they know that you're a small supplier. Maybe that doesn't matter, but if you feel that it's just none of their business, the way to keep it none of their business is to register for the GST, because then nobody knows one way or the other. Now, I do have a guide all about the GST-HST, and it's actually, this is the same link as the one I gave you before. So if you already, recorded that link, that's all you need. You're going to get both these guides actually. So I won't dwell, and I will come back to that as well. In a moment, no, you know what? Let's just keep going. Yeah, let's keep going. Because I got asked about grants, I'm going to move into another section here, which is actually about special kinds of income. And we're going to talk about grants here. Now, before we go any further, I do have a fun quiz question for you to ponder while we are talking about income, which is, which kind of income do you think is taxed the least? Your choices here, and we will come back to this later, so you have time to think about it. Your choices are burglary, betting on sports, hustling pool, crowdfunding, or cryptocurrency trading. Which of these forms of income are taxed the least? We're going to circle back to that question. And now, grants. You are quite correct that you cannot bill GST-HST on a grant. And it also is not part of that $30,000 limit. And the reason goes all the way back to the first slide that I showed you about the GST-HST, the very first point, which is that HST is a species of GST, and GST is the goods and services tax. It is a tax on the exchange of goods or services for money. And the thing about grants is it's not an exchange. The grantor gives you money, but they don't own the piece when you're done. Therefore, grants are exempt from the goods and services tax. They're exempt in every way. They're not part of that $30,000 limit. You don't charge GST, HST on top of them, but also you can't have back any of the GST or HST on expenses that relate solely to fulfilling the grant obligations. That the whole grant picture is kind of outside of the GST system. So that's the thing about grants. Now, an artist often does, and frankly, from my perspective, should declare grants as part of their self-employment income. I mean, hopefully they don't really result in a profit per se, because most grants, at least here in Canada, are project grants. They're set up to cover the costs of a project. Therefore, if you spend all the money, you're not left with anything. So you shouldn't really be taxed on them, but they should show up in the gross. They should be zeroed out by the time you get to the end of your net, but they should be in the gross. So sometimes the Canada Revenue Agency, when they're doing these sort of multiple back, they go back and they're looking at what you build, and they'll say, oh, this year she had $37,000 worth of revenue, but that $20,000 of that was a grant. And so your other income was not subject to this HST. Your other income didn't reach 30,000. So you can defend that you still don't need a GST number, that you're still a small supplier, by breaking it down and showing them that some of that income was exempt from this calculation of the small supplier threshold, even though it's part of your self-employment income. We have done that. We have written that letter, and it generally works. Yeah. So, and if you ever, by the way, sometimes younger agents don't necessarily know that, because outside of the art world, The situation with grants is not, it's not that common. When you look at a slice of the Canadian demographic, the number of people you're going to encounter who've actually received a Canada Council grant is not that high. But so you're just going to explain to the young agent that the GST is goods and services tax, and there was no exchange of goods or services in the completion of this grant. Now, another thing that you might encounter is you may sell some of your work to people who don't live in Canada. As a tax resident of Canada, all your income, wherever it's earned in the world, is reportable and taxable on your Canadian income tax return. However, when it comes to the GST-HST, foreign entities pay zero GST and HST. So if they're outside of Canada, they pay no GST or HST. However, unlike with grants, you can still claim back the GST or HST that you spend on that work. This kind of work is not exempt, which means it's sort of outside the system. It's zero rated. Zero rated means you still charge them zero because you're charging them 0% of HST, but it's still part of the system. You still get to claim back any GST or HST you spend on the business expenses that relate to your foreign revenue. Specifically for the US, of course, it's a foreign country. You do include that income on your Canadian tax return. You charge 0% GST, HST. If your work is being sold through some kind of entity in the US that withholds tax, if they withhold tax, you can apply for a foreign tax credit on your Canadian return. Essentially, it's a form that says, I gave this much in tax to a treaty country, which the US and pretty much every other country on earth is a treaty country. Not all of them, but most of them. North Korea, for example, is not a treaty country, but everybody else is. So when you pay tax to a foreign country that's covered by one of our treaties, which is almost all of them, you can get a credit back on your Canadian tax return to offset that tax. One thing that's unique to the US, though, is if the entity that's collecting on your behalf. So if you sell through Amazon or, through certain entities that are like Amazon, they may send you something called a W-8 Ben and ask you to fill it out and send it back to them. What the W-8 Ben does is it certifies that you are not subject to American tax because you pay your tax to Canada. So the W-8 Ben, a completed W-8 Ben, essentially says that you pay they don't have to withhold tax for you. They don't send it to the IRS. The completed W-8 Ben, they keep it on file, so that if the IRS ever comes to them and says, why aren't you withholding tax? They wave it around and say, because this person is a foreign entity and they don't have to have tax withheld. So it's in your best interest to complete it. The W-8 Ben can be a little intimidating the first time you see it, but it's actually very simple. The first part just says, who are you? Like your name, your address. Second part says, why are you exempt? And you're just going to fill out question 9 to say, because you pay tax in Canada, you're a Canadian tax resident. And the third part is sign here. There's a lot of extra lines and stuff, but that's actually all you're going to fill out. Send it back and they won't withhold tax. And you want them to do that not only because it makes your income tax return on the Canadian side simpler, because you don't need to do the foreign tax credit claim because there's no foreign tax. But the foreign tax credit claim, while it does offset foreign taxes, is never exactly equal to those foreign taxes. It always falls a little bit short. So you pay a teeny bit more in tax if another entity withholds tax and then you make a foreign tax credit claim than you would if they just didn't withhold the tax in the first place. So that's a preferable situation to be in. If an American entity invites you to complete a W-8 Ben, do it. If you're confused, check out my YouTube channel, Personal Tax Advisors, or Sunny's Tax Tips. My most popular video is the video that shows you how to fill out the W-8 Ben. So I invite you to do that. I should make the link part of my slides, but it's not yet. you can look at it there and it'll tell you how to do it. Question, do you have to fill in the W-8 Ben annually, or is it just one time per company? Technically it's up to the company, but generally you fill it out once. You fill it out. I mean, you're still a Canadian entity, year after year after year. If they ask you to fill it out again, just fill it out again. But I doubt that they'll bother. It's up to them. If it's up to them whether they want it renewed all the time or what. But there's no actual time period. The W-8 Ben is not technically limited in any way, but do whatever the paying entity wants you to do, because you want to make them happy so that they'll stop withholding tax. One final note about your income. If you are billing other provinces, so if you are providing, first of all, if you're providing a service and you're located in province A, and the person paying you is located in province B, the service is considered to have taken place in province B. And that matters because the province where the transaction is considered to have taken place determines what GST or HST rate you're going to use. So some provinces have the GST, some provinces have HST. And because the HST is based on a combination of the federal tax and the provincial tax, and because every province sets their own provincial sales tax rate, the HST can differ from province to province. So in Ontario, it's an HST rate of 13%. In Alberta, it's a GST only because they don't have a provincial sales tax. It's a GST only rate of 5%. In the Atlantic provinces, it's an HST, but it's at 15%. So it's all different. And the amount you're going to charge is based on the province where the transaction took place. If you're selling services, that's wherever the buyer is, wherever the payer is located, that's where the transaction is considered to have taken place. If it's goods, then it's wherever the buyer took possession of the goods. So if there's a retail outlet, it's the location of the retail store. If you're shipping the product to the client as part of your service, the transaction is taking place. They take possession at their home when they receive the package. If the person is making the arrangements to take it from you and ship it to themselves, the transaction has happened where you are. So where the transaction happens, that's what determines which GST or HST rate, or no GST, HST. That's why foreign entities don't pay anything, because it's based on where they are. That's the rate at which you charge. Okay, so I think this is a good time to take a little break. Don't you? I do. We'll take about 10 minutes here. So it's 7:01 by my clock. Let's reconvene at 7:11. If you have any questions about what we covered so far, why not throw them into the chat and we'll talk about them when we come back. Or I don't know, just throw them into the chat and we will be back at 7:11. I'll talk to you then. Okay. All right, everyone. I hope you had a refreshing break. I sat here motionless the whole time. Actually, that reminds me of something. I went to a show years and years ago. I went to a show, like a live show by this sort of comedian magician guy. He was an interesting performer. And for the intermission, so it was a little room. And during the intermission, he basically announced that it was intermission and he'd be back in 20 minutes. And then he smiled sort of like this. And he stood there motionless and unblinking for 20 minutes or 10 or whatever it was. Like he just stood there. And intentionally, that was just part of the performance. So people are like milling around, getting an extra drink, walking by him, and he just doesn't move his eyes, doesn't move his body. And then when the break was over, he just started moving again. Weird. Okay, So we got some great questions here, and there are the three questions are all kind of related, which are basically about how you handle income when basically you're taking the money, but there's a whole bunch of other people that you need to pay out of that, like fellow collaborators or the backing band or whatever that they're getting paid. How do you not have to pay tax on the full amount? And the answer is the same way you don't pay tax on a lot of things, you have to write them off. So there is a section when you are when you're self-employed, you do your math or something like that. Basically, you kind of describe your tax, your profit and loss on your business on something called the T2125, which shows, you know, like, here's my gross and here are all the things I'm writing off. And then you subtract one from the other and you get a number, and that's the net that you're going to get taxed on. So, one of the possible types of expenses you can write off, it's actually given to you there, is salaries, wages, and benefits. So if you are the leader of a band and the I don't know, the best man gives the check to you, you declare it as your income, and then you deduct everything that you paid to your backing band. And so you're going to get taxed only on the net. Similarly, if you have a grant, you declare it all as part of your gross, and then you deduct all the expenses. Remember, I said you can't claim back the GST on the expense because that's sort of not part of it, but you're going to deduct the full cost. So let's say that you got a grant, let's say for an incredibly tiny project of like $1,000, right? And you spend, well, let me put this a different way. Let's say you got a grant for $1,130. And that was because your budget was that you were going to have to buy $1,000 of supplies plus GST or plus HST. So $1,000 worth of supplies plus HST is $1,125. So you're going to show the $1,125 in your gross. Then the cost of your supplies is going to be deducted as one of your expenses, and X minus the same amount is 0. So you get taxed on the profit, which is nothing. Most grants in Canada, as we all know, are project-based grants, and most of the money that you get is part of your budget of what you thought the project was going to cost you to do. If you're right, and you know, I would assume that you're pretty close. Yeah, all the money is coming in and all the money is going back out again. You get taxed on your net, which is nothing. One particular situation that will happen sometimes with artist grants is that you will get some or all of the money in 1 year, but you haven't spent it all yet in that same year. Like, let's say that you get the grant and they give you the money on December 1st, but you don't start the project until January 1st of the following year. So in the year that you receive the grant, you must show it as part of your gross, but you can push it out to the following year by using something called reserves. This is like a technical thing that I'm not going to go into right now. Talk to your accountant about it. But basically, you're going to push out that income so that it shows up now again as income in the next year. So you're not going to pay the tax on the income until the year in which you start to spend that money. It's a specific thing that you can do with grants and that kind of income where you earn it, and the expenses that relate to it kind of don't happen until the following year. So that's how that gets handled. But just going through the 3 questions here, if I received a check from a grant for a group project and then disperse it to the members, how do I make sure I won't get taxed for their portion? So you get a check for $1,000, you disperse $900. So you're going to show a gross of $1,000, a disbursement of $900, and that last $100 is all that you're going to get taxed on because that's your net. How does paying someone for labor on a project work? You put the amount that you're paying them for their labor under salaries, wages, and benefits, subtract it from your gross, you come up with a net, you get taxed on that. Yeah, and I think that the backing band example is analogous to that, if anybody's looking at the chat at the questions. Second question, ways to mitigate the income tax on grants. How to write off the expenses related to the grant. Again, it's all the same. All the expenses relating to the grant are included on T2125. You're going to put the total amount you received as your gross. You're going to add up all that you spent. You're going to subtract that from your gross and come up with the net, which for most project grants, if your budgeting was accurate when you made the grant application, so you thought it would cost you $10,000 and they give you $10,000 and it did cost you $10,000, by doing the math, you're going to net zero. You're not going to have a profit on that grant, which is the intention of the grant, and also means that you get taxed nothing on that grant in the end. Does anybody else have questions about grants? I feel like grants could go long, so I'm a little worried about asking about whether you have questions about grants, because I feel like you probably all do. If you have any other questions, you can come back. We'll have a Q&A at the end as well. Is it a good idea to have those band members send an invoice, or is keeping track of the e-transfer confirmation good enough? Both are good. The e-transfer confirmation is actually marginally better because it is proof backed up by your bank that money moved from your account to this other person. I will say that e-transfer, so we're going to talk a little bit later about record keeping and about how you have to keep everything for 7 years. And banks will keep everything for 7 years. They'll keep their stuff for 7 years because of this rule. So you can always go back up to 7 years and get information about your bank account. But e-transfer is actually a private, I don't know if it's a company, but Interac is a separate company. Interac is the entity that manages e-transfers. The upshot of that is that you cannot find out any details about an e-transfer from Interac or from your bank 7 years later. So I would recommend that once a year, you can go into your bank and you can sort of download the history of money received, or money spent actually is more important to you. Download that once a year and put it with your stuff. Don't rely on Interac to still have it if you have to figure it out or defend it or anything like that later. It's kind of, that record does not last. So make sure that you download that. And the invoice is also good, just, partly for yourself and partly to back up your claim that this was actually a business expense and not, for example, a personal transfer of money to a friend. So you want both, really. You want the invoice and you want the e-transfer confirmation as well. Okay. Moving on. You're welcome. So we had this delightful quiz question of which of these forms of income are taxed the least. Again, your options are burglary, sports betting, hustling pool, crowdfunding, or cryptocurrency trading. Which do you think is the least taxed form of income? Crowdfunding, got one vote. If nobody else vote, robbery. Okay, robbery, tax-free, you're thinking? All are taxed? Interesting answers here. Anybody else got a guess? Does anybody want to guess one of the things that has not been chosen? If you dibs it and you're right, you get the bragging rights. Crypto, okay. So we've got crowdfunding, robbery, crypto. Nobody's chosen. Is there any way? I know Alex is voting kind of strategically. She wants to make sure that she has a shot here. She's voting for something. I know it because she's competitive and she scares me. All right. I knew it. All right. If there are no other bets, I'm going to reveal. I know that you're all on the edge of your seats. So here we go. It's not burglary. Burglary, the proceeds of crime are taxable under the Income Tax Act. So if you're going to rob somebody, that's between you and the somebody you robbed and the police, but you better declare it on your income tax as the proceeds of crime because it is taxable. Hustling pool is also considered to be taxable. It's considered to be basically self-employment. Cryptocurrency is taxable every time you trade in cryptocurrency, like not just when you buy it or sell it, you buy it for $10 and you sell it for no dollars, that's considered to be a, well, that wouldn't be taxable. But if you bought it for 10 and sold it for 15, you would actually obviously declare the $5 as profit. But actually, even if you trade one cryptocurrency coin for another, at that point, a barter is considered to have happened, and barter is taxable. People try to avoid taxes by bartering. So they try to do non-cash transactions or trading stuff in the hopes that they won't get taxed. And it's true that the Canada Revenue Agency maybe does not see that transaction happen. However, by their rules, you're supposed to convert the value of the things that you traded to Canadian dollars and declare it as income. So if you give somebody a painting, you've sold them the painting in exchange for a small dog, you have to figure the fair market value of the small dog that you received, and that's part of your income. Crowdfunding is basically considered income as soon as you receive the money. It's income. So even if you never carry out the thing that you crowdfunded for, you have to call that income. So that leaves us with sports betting. Sports betting is not taxable, and they have tried this in court. The Canada Revenue Agency does not like that sports betting is not taxable. The specific example is that somebody had a whole enterprise and typically made $300,000 gross through sports betting, like every year. It wasn't a lucky shot. This person just knew how to do it, and they had a reliable income from sports betting, and it's not taxable. And this drove CRA crazy because it was clearly they knew how to do it, but it's still considered to be a win by chance. And anything that you win by chance is not taxable according to the income tax rules. So that's why, for the same reason that you don't get taxed on your lottery winnings or raffle winnings, you can't be taxed on sports betting either. Even if you're so good at it, you always make a profit. So there you go. Sports betting. Betting on the ponies. That's what you want to do if you want to stay tax-free. So setting aside money for tax. When you have money from salaried employment, and we've all, I think most of us have done that at some point, you don't get paid the total amount that you earned, right? They withhold some for tax and CPP and EI, but we're talking tax here. They withhold it. Your employer is withholding it in part because they are legally obliged to. If you have an employee, you must withhold a certain percentage of income for tax, and that amount that you're withholding is actually set by the government. There are rules that determine what an employer is obliged to withhold. What they withhold, they do not keep. They send it directly to the government, like pretty much right away. Around the same time you get paid, the government gets paid. And then your T4 will report what you earned and how much of that was forwarded to the government. What happens when you file a tax return? Your filed tax return is the first time anybody knows exactly what you earn from all sources and exactly how taxable you are, because it takes into account your RSP contributions and your charitable donations, maybe childcare, and all kinds of different things sort of come into play all together on that income tax return. So when you create the income tax return, this is the first time that your actual income tax bill has been calculated. When you are solely an employee, the amount that's withheld by law is usually enough to cover that bill. It's usually a good estimate or even a little bit too high. So if too much has been withheld for you, when you file your return and it shows that what you actually owe is lower, the remainder is sent back to you as a refund. That's how refunds work. Self-employed people, nobody is withholding tax. You're going to owe tax on what you're earning in the year, but during the year, nobody's withholding tax for you. You're going to have to pay it at the end. And that's why self-employed people typically don't get refunds, because there's nothing against which to compare your tax bill. Nothing has been set aside. Therefore, there's nothing to refund to you. So instead, you're responsible for figuring out, as the money's coming in, how much of it to set aside for tax. And this can be complicated. Like I said, the amount of tax that you're taxed is not based on the gross. It's not based on how much money comes in. It's based on your net after expenses. But the problem is almost nobody is tracking this on a day-by-day basis. Like almost no self-employed person knows exactly what their business expenses are as of this moment and their revenue as of this moment in order to get a perfectly accurate estimate of their taxes owing. Some businesses are more expensive to run than others, so they have a lower profit margin. So less of that initial dollar earned is actually going to be taxed. Some businesses have a very low expense. You know, if you've ever done, you know, maybe you do lithography, it's very expensive. It can be expensive to do certain kinds of art, and it's very cheap to do other kinds of art. Like maybe your art is like pen and ink drawings literally done with a ballpoint pen. Your expenses are low. So most of what you bill, you're keeping as your net. So you have a higher amount of tax to pay on every dollar that you earn on your sketches. So how do you determine how much money to set aside? The best you can do is an estimate. We find that for most of our clients who sell services, so this is the least expensive thing to sell, right? People who sell services keep the biggest proportion of what they bill because their only expense typically is it's their home office and their computer. That's it. But people who, like sculptors, for example, or jewelers, have very high expenses. So people with the low expenses, we find that they end up having to remit between 15 and 20% of every dollar they earn through their self-employment. But that is actually the lower limit. So you would want to start at 20%. If you are, that's actually the higher limit, right? No, let me take that back. If your expenses are super low, I want you to set aside 25%. If your expenses are average or modest, I want you to set aside between 15 and 20. And I actually don't want anybody to set aside less than that. To be on the safe side, the more you set aside, the safer you are when tax time comes and you get your actual bill, right? If you do a form of art that is a physical art form, generally 20% of your billed revenue will be enough to pay your taxes. But if you do an art that is super inexpensive, just doesn't cost much to do, no materials cost, for example, set aside a higher percentage, set aside closer to 25%. That should be enough to either get you within spitting distance of what you owe, or the more you set aside, of course, the more you've overshot, the more likely you are to not have to owe it all to the government. So if you've imposed upon yourself a 30% withholding, that's going to be more than you owe. Almost inevitably, it's going to be more than you owe. And any extra that you've set aside that you don't need to pay your taxes, you get to drink. So that's an option as well. So if you're a very cautious person, set aside as much as possible. Less cautious, go for about 20%. The other thing I want to say is that I know that in the arts, you can go through some lean times when you need all the liquid cash you can get. And there are situations where you earn so little that you don't have to pay any tax or CPP at all. But they're rare. And even when you're not earning much, you may still be taxable. And as hard as it may be to set aside your gross as you're earning it, when you really would rather spend it, finding that money at the end of the year, when you've put together your taxes and you realize you owe it, that is even harder. How hard it is to do it during the year is usually not as hard as doing it at the end of the year. So don't overlook this part. Set aside an allowance for tax. And where do you do with it? Well, there's no law about where you're going to set it aside, except the law of psychology, which says that if you can see it, you're more likely to consume it. I recommend you put it slightly out of your reach. So for most people, I would say that that would be an online bank account like Tangerine or Simply. These are accounts that you can't really use for a heck of a lot. You can't really, usually you don't use them to, pay your utilities bills. And when you do want access to the money, you have to transfer it to your regular daily account, and it takes a couple of days. And this is like the equivalent of taking the cookies and putting them on the high shelf and making them just a little harder to get at, meaning that you have a little more time to think about it. So while I don't think that you should lock it away in a place where you can never get a hold of it, lock it away in a place where it's a little harder to get a hold of it. And also where you don't have to see it all the time, right? If you do your banking at CIBC, your day-to-day banking, and you have an account at Tangerine, you're not seeing those amounts on a daily basis. You can sort of forget about them. And that makes it more likely that you're not going to spend them because you don't want to spend them, right? You want them set aside. And by the way, wherever you're setting aside your allowance for tax, that's also a good place to set aside any GST or HST that you are billing. Set aside all the GST or HST that you're billing. Mathematically, the most you will ever have to remit is the amount that you charge in that tax. Usually it's a little bit less because you are going to claim back the ITCs you're going to claim back the tax that you spend on your business expenses. So you usually have to remit a little bit less, but why not play it safe? If you bill $200 in GST, set the whole $200 aside in the same account where you set aside your tax allowance and just don't touch it. At the end of the year, you will almost certainly have more than enough to cover your tax remittance. You get to keep the extra. It's a nice surprise at the end of the year instead of a nasty surprise at the end of the year. Let's talk about deadlines, because the Canada Revenue Agency definitely does. As we all know, the Canada Revenue Agency is run by bureaucrats. And bureaucrats love paper. They line their nests with it. It makes them feel safe and warm. And what they really hate is not having paper, because then they don't feel safe and they don't feel warm. Or not having paper at the time that they expect to see that paper. These are the filing deadlines. They hate it when you miss a deadline. And in fact, they hate waiting for paper more than they hate waiting for money. Now, I know that's counterintuitive because we are human beings and most people care about money more than paperwork, but we are not bureaucrats and they are. The degree to which they care more about paper than about money can be seen in what happens if you make them wait for one versus making them wait for the other. If you make CRA wait for money, they charge you interest. It accrues daily. There's interest on late payments. Just like there is on late payments to anything, there's interest. If you make them wait for paperwork, there's a fine. And the fine, they call it a penalty. So if you file a return late, they charge a penalty on top of your taxes. The interest applies to both the penalty and the tax, retroactive to when you should have paid, when you should have filed the return. So the penalty reflects how much they hate you missing a deadline, and the interest reflects how much they hate waiting for money. And the fact is that typically the penalties are way higher than the interest. I mean, unless you're 20 years late, then obviously the interest will eventually overtake the penalty. But in the range of a few years, if you're a few years late filing versus, few years late paying versus few years late paying, the penalty will actually exceed the interest. They really want the paperwork. So I know that it's tempting, if you suspect or if you know that you can't afford to pay the tax that you owe and you don't want to file the return that shows that you owe it, file it anyway. File on time, even if you can't pay on time. Make them wait for the money. They've got processes for it. You'll keep getting bills. They'll keep adding that interest. Fine. You take care of it when you can take care of it. But don't make it that much worse by filing the paperwork late and having them actually make the bill bigger to begin with. Okay. If you pay a day late, the interest is almost nothing. But if you file a day late, they add 5% to your tax bill. So don't do that. Don't make them wait for paperwork. Now, there are also deadlines in their letters. They'll ask for, usually their letters are asking for either proof or information, or a combination, information and proof. They usually say they want this by such and such a date. If you can, get them whatever they're asking for by that date. If you can't get it to them by that date, call them before that date. They'll usually move the deadline. They will move it. They will move the deadlines in their letters. If you don't meet the deadlines, let's say they are asking for a rent receipt, which they sometimes do, and you miss the deadline. The rent receipt was perhaps to defend a claim for an Ontario property tax credit that would have been worth a few $100s to you. They say, well, we didn't get the rent receipt that we asked for, so we're going to disallow the credit. And so you're not going to get the few $100s you're entitled to. Later, maybe you find the rent receipt, or you reread the letter and realize that that's what they were asking for, because sometimes you don't read too closely. Something about those brown envelopes sometimes make people sort of lose their minds a little bit. Okay, so later on, you discover the rent receipt. They've disallowed the credit. You can now get the credit back, but now you have to create a cover letter and explain, okay, this is regarding the property tax credit. I know you wanted the rent receipt. Here's the rent receipt. Here's the application form. Again, can you please give it to me? It's a bigger process to create, to go back and address something out of the blue than it is to respond to them. So if you respond within the deadline, it sort of goes smoother. They'll just go, oh, here's the receipt and there's your credit, as opposed to, an envelope. What is this about? I will send this down the pike to be, it's just faster to just pay attention to their deadlines, if you can. Now, of course, the most famous deadline is the April 30th tax filing deadline. We are always very aware of that. Our season starts getting busy around March 1st because of this April 30th deadline. What some self-employed people don't know is that they actually all get an extension. Anybody with any self-employment income in Canada, regardless of their other sources of income, gets a 6-week filing deadline. Anybody with self-employment income, even if they are also an employee, has until June 15th to file their income tax return, as do their spouses and or common law partners. So if you have any self-employment income at all, not only you, but your partner get until June 15th to file. So that's a nice thing about this deadline. Is actually moved. If you, when you registered for the GST, if you opted for annual filing, generally that return is also due on June 15th. So that's very nice. Everything's due at the same time. That's kind of good. So, if you're ever, looking for romance and you're, working on somebody and trying to close the deal, you might point out that if they, they play their cards right, they might get a 6-week tax filing deadline extension. So see what that's worth. Who knows? Tax trivia. This is a married woman on the Isle of Jersey in the 50s. What does she need to have in order to discuss her taxes with her government? Anybody want to hazard a guess? Anybody? It's the 50s, remember? A fun time for women in general. What do you think? All right, let's get a few votes there in the chat. In the meantime, in case you manage to miss it every other time, this is that link to the guides that I'm offering. I'm also going to circle back and I'll give you a link to the guide to what to do if you're a few years behind on your filing, in case anybody wants that and has missed that. The permission of the patriarchy. You know what? You're all winners. What she needs is written permission from her husband to discuss her taxes with the government. Basically, she needs a release from her husband that will allow them to share this very private information with someone not him, her. So there you go. So yes, permission from her husband, permission of the patriarchy. That's exactly what this 1950s housewife from Jersey needs. Now, for bonus points, this was fun. When did that law change? When did it change? I'm posing the question. I want you to tell me in the chat when you think the law changed. And I'm kind of looking forward to what Alex says. I mean, I'm not playing favorites here, but like, how will she play it? But she can't play the game unless somebody else puts in a vote here. So what do you think? When do you think it changed? When did it change? Oh, come on. You're not just going to hand it to her because you know she's going to vote. Okay. Thank you, Pauline. 1980, 1985. Trick question. Ooh, Michelle is a tricky person. It takes one to know one, Michelle. I'm not. Wow. What do you take me for? So our votes so far are that it's a trick question, or it was in the era of neon clothing. Does anybody have another vote before I close this contest down? Anybody? A COVID thing last couple of years? Interesting answer. Okay, 5 seconds. Anybody else? All right. I can't believe this. I can't believe this, but I have to give it to Alex. God. It changed in 2020. That's when it changed. I had a tax preparer working for me one time. I feel like he was always trying to provoke me because he used to say that, oh, he'd, never marry a feminist. It was not in the offing, trust. He'd never marry a feminist because feminism was an outdated notion because women had equality already. And then like 3 years after that, the law changed so that a woman in Jersey could get information about her own taxes. And I thought, yay, feminism. Yeah. Paulina, I don't know who that thumbs down is for. I don't know if it's for her husband, for patriarchy, for neon clothing, or for Alex, or for me, but it's all bad. All of it, including the neon clothing. So, all right. Coming around the home stretch here, let's talk about keeping records. So, as your oh, okay. Yes, that is that's a downer, not 2020. So as you're deciding what to write off and how to write it off and who you paid and keeping your various records, you've got a shoebox full of paperwork. What do you need to have in that shoebox? Now, the Canada Revenue Agency can review returns up to 7 years in the past. You are obliged by their rules to keep your stuff for 7 years. And that's 7 years from the end of the tax year to which it pertains, or from the date that you filed that return, whichever comes later. So if you can actually go back and file returns that are older than 7 years, right? You could actually go back, you can go back up to 10 years. So right now you could file a return from 8 years ago, but you still have to, the clock starts now. You have to keep the materials for 7 years starting now. You're not off the hook because it was already 7 years ago. So the later of when you file it or the end of the tax year plus 7 years, that's how long you have to keep stuff because CRA can ask to see it. Beyond that, CRA can't ask to see it. So I would say anything that's older than that, go ahead and destroy it. Legally, you will never need to produce it for the CRA. So why have it? In fact, I would even say if you have paper records, and I think that even in this era of digital this, digital that, I still think we all end up with some paper records. I mean, if you take a cab somewhere, you're still going to get one of those little, taxi chit things, potentially. maybe not now. I guess you can get the receipt emailed to you now. But whatever paperwork you're keeping, go ahead and write on the box not just what year it pertains to, but what year you can throw it out. So that when you're going through a purge, you can easily see what year you can just throw it out. Now, what's in that box? Well, the vendor's receipt. Okay, so this would be either, if you went to a bricks and mortar store, this might be the cash register receipt. If you bought something online, it might have been emailed to you as a PDF. If it's a service agreement, let's say for your cell phone, and you don't get a monthly bill from your cell phone provider, maybe the only place that indicates what you're going to pay for is the original agreement. So keep the agreement handy in case you ever have to show it off. You probably won't, but keep it, because that's the only evidence you have. I often get asked if people can just keep the credit card statements because it's so much tidier and easier. And it is, right? Like a credit card receipt, you can see everything. It's sort of all lined up. It's nice and clean. You can see the amount. If you paid for something in US dollars or some other foreign currency, it's converted to Canadian right there. So handy. And the answer is no, that is not sufficient. This does not mean if you only have the credit card statement and you get reviewed and CRA wants to see proof, it doesn't mean automatically that you're not going to be given, that they're not going to let you have it as an expense. But they don't have to, because their rules specify that it must be the vendor's receipt. It has to show not just the amount, but the date and the name of the vendor and the address of the vendor. Those last two usually aren't exactly, like the legal name of the vendor often is not on that credit card statement, and the address, of course, certainly is not. So really, you have to keep the actual receipts, not just the credit card statements. I still recommend that you keep the credit card statements for your own purposes. I still think that they're a great way to make sure that you didn't miss anything. I still think that if you only have the credit card statement and no other invoice or receipt, to just write it off anyway, because A, you may never get audited. B, even if you get audited, they may never ask about that specific expense. C, even if they ask about that specific expense and you only have the credit card statement, they might accept it anyway. So it's not a reason not to bother writing it off in the first place. But the bulletproof thing to do is to have the vendor's receipt. Now, if that receipt is printed on that shiny, crinkly paper, we all know what happens to that stuff. We all know that it disappears. Like, it can disappear sometimes in the time it takes you to get it out of your pocket and put it into your shoebox. It's certainly not going to be legible 7 years from now. So I do recommend that you make a photocopy of that while it's still legible. Quick tip, if the photocopier isn't sensitive, if you can read it, but it's yellow, you can read it physically, but the photocopier can't, try the photo setting. The photo setting is usually the most sensitive, and anything your eye can pick up, it can pick up. I also recommend, not necessary, but I do recommend that if you have more than one credit card, pick one and just put all your business expenses on it and only your business expenses. It's just going to make your record keeping easier. It also helps you with your write-offs, because if you leave a balance on your credit card for business expenses, that interest is actually a tax deduction. It is an interest charge. So if you have some business, some personal, and there's a balance on your credit card, is that balance business or personal? Therefore, is the interest business or personal? If everything on the credit card is a business expense, then any interest on that credit card is business interest, and you get to write it off. I don't recommend you keep a balance on your credit cards anyway, but if you must, keep a separate credit card for your business. Not necessary, just handy for you. What is the best record keeping system? Can you just throw it all into a sock? Should you keep it all in a spreadsheet accurate to 4 decimal places? Should you use Microsoft Money? Should you use QuickBooks? Should you use Wave? Should you use, I don't know. There's a million options for how you want to track things. Which one should you use? The answer is yes. The answer is choose your record keeping system like you choose your fitness regime. well, like you should choose your fitness regime, which is choose the thing that you can do consistently year round all the time, not just when you're filled with fire, but all the time. What is the amount? You know yourself. What is the amount of time that you're actually willing to spend taking care of your business expenses in a month, in a week? 5 minutes? Really? Maybe 5 minutes a week plus a couple of hours or an afternoon around tax time? Is that what you can do? Then do that. First of all, make the storing of your expenses easy and fast. You can separate that from the sorting of your expenses. That can be its own thing. It's important that you get stuff saved, right? It's better to have it and not need it than to need it and not have it. So it's very important to have it. So if the best thing for you is to just have a box where you throw things, then do that. You can go through it later. You've got all the time in the world, but make sure you have everything. Similarly, you need a folder to put your emails in if you get some of your receipts that way and you don't, either save them as PDFs and have a folder on your computer where all those receipts go, or have a folder in your email where all those emails go so that it's easy to find them. But more important, what makes things easy to find is having them put away in a logical way. And what makes it likely for you to put things away in a logical way is that you make it easy. Do not have a million places. One place for your physical receipts, one place for your PDFs, one place for your emails. End of story. And make those places easy. If the lid to the box is one that's awkward to get off, get another box or cut a slot in there. Make it easy. Make it easy. Because when I'm working with somebody's taxes or when you're working with your own, having 2 weeks of perfect records and then 50 weeks of nothing, not helpful. Your records are only as good as your long-term record keeping. In this, consistency is key. Do what you can consistently do. Don't expect yourself to do more. Know who you are. Now, we have 5 minutes for any remaining questions before I wrap this puppy up. Anybody got a question? Here are the guides. You already saw that one 3 times, so let's just stick with this one in case somebody needs this one. This is the one about if you're behind on your tax filing and you need sort of a roadmap out. That's this guide over here. This one is separate. So that the other link will get you both the GST guide, HST guide, and business deductions guide. This one is specifically my guide to being overdue with your taxes. All right. So it's getting pretty late. People are putting their kids to bed. People are leaving. Let's just wrap up this puppy. Always, Forest City Gallery, thank you so much for having me. I really always enjoy doing these things. But I do hope that you've carried away this one really important point from all of this. And that is, there are things you need to know, and there are things you need to do to stay on top of your requirements with regard to tax filing. They are doable, they are manageable, and it is way easier to do them than to get caught not doing them. It is easier to stay out of trouble than to get out of trouble. And because you were here tonight, I hope, and you were paying attention and, not asleep, I don't know, hopefully you will never be in this situation because you know everything you need to know. And I am gratified to feel that I have done that for you all. So that's all I have to say about that. And I'm going to hand it back to Ruth.
Honey, that was awesome. Thank you so much. It's such a stressful thing to think about finances. I was just chatting with friends and it's filled with doubt and anxiety and guilt and all of those big emotions. And
Right?
you packed so much for us in such an accessible way, and it's empowering, as we said. So we really appreciate your time, appreciate all these resources, and we'll be sharing this through our YouTube. Thanks for those of you who put your email in the chat. We'll make it available in the next day or two. And yeah, Sunny, we'll see you next year for our next adventure. For sure.
Okay, happy to do it. I also have another presentation that I offer that's more about keeping records. So if you're interested in that, maybe later in the year, during the year when you're actually doing this stuff, it's a bit late for 2023 to learn how to you should have kept your records. But I have a sort of a talk about audit proofing your records that we can probably do a little bit later when things are a little less crazy over here. And for all of you there, thank you for having me. And I will definitely be back anytime you ask.
Thanks so much. Take care, everyone. Have a good night. Good luck with your taxes.
Night, everybody.
Night, good night. All
Thank
best.
you.
You're welcome.
Thank you. Sorry for scaring you.
All right.
That was just a lucky guess, by the way. I was just
It's so funny. It's so funny. You care the most, though, so you deserve to win it. You're in it to win it. All right, you guys. Have a great night, guys.
Bye-bye, Sunny. Take
Bye.
care. Awesome. That was awesome. Just making sure I've got everything I need here. Yeah, great.